One of the biggest mistakes we see new sole traders make is spending all the money that comes into their business and then being absolutely horrified when their tax bill arrives. So if you're self-employed, how much should you actually be putting aside for tax? I'm going to run through some real examples, explain why your January tax bill can be much bigger than you expect, and give you a simple rule of thumb for how much to keep aside. First things first, your tax isn't based on how much money comes into your business. It's generally based on your profit. So, if your business takes £60,000 during the year, but you have £20,000 of allowable business expenses, your taxable profit is around £40,000. And that's the figure we're interested in when we're thinking about your income tax and national insurance. This is one reason keeping your bookkeeping up to date is so important. You don't want to be putting away far too much money because you're ignoring your legitimate business expenses, but equally, you don't want to spend money that you actually need for your tax bill. So, the big question, how much should you actually put aside? There isn't one percentage that works for everyone because it depends on your profit, your other income, and your personal circumstances. But as a rough starting point, putting aside around 20 to 30% of your profit for tax can be a sensible habit for many sole traders. For example, if your business makes £40,000 profit, you might want to have somewhere around £10,000 to £12,000 set aside. If you make £60,000 profit, you're potentially looking at putting aside around £15,000 to £18,000. And if you're earning significantly more than that, don't just assume 25% will always be enough, because as your income increases, you can move into higher tax bands. It's important that you know that these figures can only be used for budgeting, rather than a calculation of exactly what your tax bill will be. Now, here's where things catch a lot of people out. Payments on account. You might think you've done your tax return, you've been told your tax bill is £5,000, so you need £5,000 in January, right? Simple. Not necessary. If you're required to make payments on account, HMRC may ask you to pay your £5,000 tax bill plus an additional payment towards next year's tax. So, your January bill could actually be £7,500. Then in July, you may need to make another £2,500 payment. So you've suddenly needed £10,000 across the year, even though your original tax calculation was only £5,000. And this is why someone can have a perfectly profitable year, think they've got plenty of money sitting in their bank account, and then suddenly realise a large chunk of it isn't actually theirs to spend. It's money that needs to go to HMRC. So what should you do? Well, firstly, get into the habit of moving money into a separate savings account every time you get paid. This prevents you from overspending and allows you to clearly see what you have saved up for your tax bill. Secondly, don't rely on your bank balance to tell you how much profit you are making. Cash doesn't equate to profit, so make sure to stay on top of your bookkeeping. And thirdly, Get your accounts and tax return done early. The sooner you know what your actual tax liability is, the sooner you can plan for it. So, if you're self-employed and you're wondering how much you should keep aside, 25 to 30% of your profit is a reasonable starting point for many people, but it's not a substitute for calculating your actual tax liability. And if you're approaching your first tax bill, make sure you've also considered payments on account, because that's where the really nasty surprise can come from. If you're a sole trader and you're not sure how much you should be putting aside, speak to your accountant before you spend it. Future you will probably be very grateful. And if you found this useful, give us a follow for more straightforward tax advice, and we will catch you in the next video.